You out in cyberspace, it's time to get back out and to get to these conferences. I've accomplished more in the past 2 hours than I have in probably 50 hours of Zoom calls over the past 2 years. So I would encourage people to come back out, come back to the conferences, and because that's where the business actually gets done. It doesn't get done on Zoom. Sorry. So my name is Gifford West. I work for Alpine Tremont. Alpine Tremont, if you think of the NPL industry as an ecosystem, we are the advisors into that ecosystem for existing players, buy-side, sell-side, and vendors. We do buy-side advice in terms of how to enter the market, sell-side, how to run a sale, and vendor strategy in terms of how to improve your positioning in that market. So right now, we are running 3 loan sales, and we're advising a challenger bank in the UK on raising equity. This is what we do. I'm very excited about this panel. I've got some opening comments, but first I'm going to ask my colleagues to introduce themselves briefly as to who they are and where they're from.
Yep, sure. Let me begin, I suppose.
Yes.
With someone. So, I'm Alex Estratoglu. I'm the Business Development Director for Relational. Also, I'm very happy to be amongst such esteemed colleagues here on the panel as well, but also on the audience. It's very good to see familiar faces on the previous panel as well. We are a software provider, international software provider. We are based in Greece, in Athens. We were founded in 1995. Our main business are actually have to do with financial services as such. And we provide our own proprietary tools for loan origination and debt management. So we see this, as a credit life cycle that we can cover end to end, actually the whole process. And this is where we see our competitive advantage to be. We are more than 300 people, so we are a big company. We are on the financial tech. We are considered ourselves to be a fintech as well, because we need to evolve. We need to augment and provide additional services to our clients. We operate in 27 countries in the EMEA region, Europe, Middle East, and Africa. And as all esteemed colleagues will say, we want to have, a happy customer. This is our vision at the end of the day. So, yeah.
Thank you. I'm John McDonald. I'm the CEO of Recognite. Recognite provides end-to-end of the life cycle of real estate, be it performing or non-performing, with data and technology solutions. I'm also on the advisory board of the AI Forum and advising a number of insurtechs, fintechs, around the use of blockchain and distributed finance, long-term technology background for banking, capital markets, and insurance.
My name is Fulvio Pelargonio. I'm one of the founders, currently head of business development at NPL Markets. NPL Markets is a company which is providing loan sale platform, advisory, data management, and reporting for portfolios which are put on sales and which are actually held by investors. We're working with banks, hedge funds, servicers across Europe, aiming at digitalizing and facilitating the sale and the management process of portfolios of loans, non-performing and also performing.
My name is Johnny Lingvall, and I'm CEO and co-founder at Dignisa. Been at the company since start, which is late 2017. Prior to Dignisa, I've been on the investor and servicing side at Intrum Sweden for 5 years, and prior Intrum, I was been in the IT industry working with different type of BI tools for more than 10 years. And I would say Dignisa is more or less a combination of these 2 worlds, applying modern technology on the life cycle of a credit, helping the market, I would say both issuers and investors, analyzing payment patterns, collection processes, setting up and build efficient benchmark modules with scorecards who drives performance accordingly as you as an issuer that you want to. And when it comes to the asset part, evaluate different type of sales strategies, evaluate portfolios, build portfolios, and then of course, when it comes from the investor side, evaluate portfolios pre-investing, and then when you have invested, applying benchmark strategy to improve collection performance. So I'm happy to be here.
Thanks. My name is Paul Josefak. I'm also the founder and CEO of Receive. We're a company actually based out of Germany, but focusing on Europe and LATAM primarily at the moment. We are actually a software platform. We sell the platform as an enterprise SaaS solution. We address the whole value chain from collections all the way through to NPL management. We want to ultimately be the underlying data layer for the whole industry. So we're basically saying that ultimately you have to capture all the data before you can do anything with it. We all heard the other panels talking about everything that you can do along the stages of the value chain. We want to be the underlying platform that captures all that data and is allowing everyone to basically work with it and leverage it to get better at their quasi-business. That's what we're doing at Receive.
So the panel got together on a series of Zoom calls last week. They're the Zoom calls, which I despise. And where we want to go with this panel, the previous two panels were very good, excellent discussions. Well, we're trying to take it up a level. So Sam made the point in the first panel that JP Morgan was going to spend $12 billion a year on IT going forward. And Charles made the point that 95% of the European banks' senior management were bankers, which I took as code word for old guys, and that they knew nothing about technology. And so what we thought would be interesting is to try and take it up a level and say if the audience that we're targeting is the senior management who really are still figuring out what the cloud is, and they know they have to spend all this money, and they have all these technologists coming up to them and saying, hey, you need to use AI, you need to use this. What should they be focusing on? What are the things that, what do they need to think about over the next few years? So that's how we're trying to frame this panel, not specific technologies, although I'm sure we'll go into them, but rather for the non-tech crowd, what should they be worrying about? So with that in mind, what are the technologies that represent the best bang for the buck for senior management over the next 12 months or 20 months? And how does that differ if you're buy-side, sell-side servicer? And Paul, would you mind taking the lead on that?
Sure. So in my opinion, I think the most important thing that you have to focus on first and foremost, and be it 12 or 24, however many months you want to talk about, is getting the access to the data. You can talk as much as you want about AI or basically all the things that people want to do when it comes to collections, but if you look at quasi the data that's available in the market, it's not homogeneous. No one has the same quasi quality of data. There's almost no data hygiene between players in the industry. And if you can't get that data hygiene in place, first and foremost, you can almost forget doing anything and everything thereafter. And if you think about the buy or sell side, what's one of the biggest problems right now? There's intransparency. You don't know quasi what the other side knows. And so from my perspective, if you kind of really think about what you need to do first is you need to address the data so that you can actually leverage it. And so from the perspective of what we're doing with Receive, we're saying, look, if you can add transparency and if you can basically clean up what everyone is working with right now, you can start leveraging it. And you can achieve quasi things in 12, 24, 36 months that can help your core business. But first and foremost, you have to lay the groundwork. You have to have platforms in place. You have to have APIs in place. You have to have interoperability. Once you get that, then you can start doing the really exciting, sexy stuff. But first and foremost, you have to lay the groundwork. And I still think a lot of these companies are required to lay the groundwork. It hasn't really been done. And there's no way for multiple parties within the industry to work together. You're always quasi starting at square zero every time you start a new process. And there's no flow through the whole value chain, which is something that I think you have to put in place first before you can really digitalize.
Interesting. Who wants to jump on it next?
Maybe one thing is actually that when it comes down to NPL, unlike the discussion we had in the previous panel, you're talking about something which is old. So you've got a lot of legacy stuff, and actually when you're talking about getting the data, if you're talking about a loan which is granted today, probably you got everything and everybody will keep in place for next years. So when it comes to this loan to be sold, and you get probably a lot of data, no? The guy's got a phone, yeah? When you're talking to NPLs, no, some borrowers are dead. No, so they don't have an address. So the property may be still there. No? So there's a legacy element which actually hinders a lot. No, to this process we're thinking about. And just to give you anecdotal stuff, when we started doing NPL, and we were classifying files with the words of kids, bambino. So we're talking about a file which is a 3-year-old kid or a 5-year-old kid. And it was not how old the file was, but how thick. So this is 3-year-old file, 5-year-old file. And they were full paper, right? No, most of those files are still there. So, and how can you get the data when the data is thousands of pages, probably useless, right?
Sure.
So it's this element you have to take into account.
Yeah, but we don't want to go backwards, right? So let's be
Exactly.
realistic. We don't want to go backwards, and that's what you actually, unfortunately, encounter all the time in this industry. Everyone's basically saying, let's look backwards and address the past. You have to almost think about what do we do in the future. Technology is not going to help you get the data that you don't have, right? I mean, I know exactly what you're talking about. There's just missing phone numbers, missing addresses, whatever, right? So you can't address that just by saying we're going to throw data at it, right? But you have to start thinking about what's going to happen in the future and what's this industry going to evolve towards. And let's be honest, we talked about this on the phone. The transparency or the lack of transparency is quite helpful for either the buy or sell side, right? So a lot of people in this industry love the fact that there is intransparency. It works in their favor.
And I agree. I mean, you have to start walk before you run.
There you go.
Yeah, I mean, and everybody should always strive against the transparent picture and the end-to-end picture of the data. I mean, otherwise you can't work with your, internal efficiency, both on the short term, but also on the long-term perspective. So I mean, and I say the general problem is that many of the players on the market are working with the data quality, etc. But they hinders about the obstacles that means that you don't being able to transfer the data into actionable data, and you have to start somewhere. Obviously, you have some problems with data quality, but if you don't start and working towards the transparent view from an end-to-end perspective, we will never progress in this area.
Absolutely.
Yeah, if I may, just...
John, you first, then John.
Yeah, okay. So I totally agree with what the guy said. It's actually, what I say is, show me the data. No, it's show me the money, show me the data. Why? Because, okay, you are always hearing about buzz terms like machine learning, AI, stuff like that. But indeed, before you start to run, you need first to walk. But in order to contradict a bit here, it's actually, yes, from our experience as well, data seems to be of poor quality in general, but there are ways to help out. There are techniques, specific techniques that you should base on processes as well, of course, but there are ways in order to enhance and enrich current data. We have been seeing that with such exercise we have been doing, about data cleansing as well, stuff like that. There are specific techniques that you can use in order to help out your customer and enrich their data pool, let's say. Sorry, yeah.
Yeah. At the beginning of this, actually, before Gifford says, look, take a look at the long term. So I sort of get the crystal ball element to a degree, and I sort of lift it up to you need to digitalize knowledge. And everything we're talking about is preparing for that knowledge. But let me give you a completely different example, and something I was involved in, that people build up knowledge. Sometimes it's in case notes, sometimes it's in files. And IBM with Watson, the machine that won the big game against people, what they did is looked at cancer. And they said, actually, I'm a consultant, I'm an expert, but I don't know very much compared to about the outcomes or the knowledge that's everywhere else. Let's read the world's knowledge. Let's incrementally build up on it so I can make better decisions. And when you look at almost anything, it's allowing you to use the really superior knowledge that might be in one person's head about how to do something or what happened, what was an outcome, and make that available. So democratizing knowledge. And there's lots of small steps you can take to that. It's look at your own data first. You've got contracts, you've got the paper files, you've got the Bambino stuff there. Read it. Machines will read it, machines will extract it, but then layer on knowledge. Look elsewhere. Look at your extended capability, other case studies that may have been relevant to a particular case that you're looking at. But find public data as well. It's easy, relatively, to pull that in and layer on understanding of what you know, and then apply how you're going to use it in all sorts of ways across the business. So that's why I sort of really look at it as digitalization of knowledge. And then ultimately you start syndicating that. And this is where, you know, people talked about blockchain and distributed finance, but what a lot of effort, cost, and basically erosion of margin and return goes into is non-productive activities. And they're common across everybody. If you've got a collection agent, if you've got yourself the owner of the asset, maybe you've got legal firms, surveyors, whoever is else involved, actually, there is no advantage, no proprietary advantage in them having to find the same information. So make data a utility. Share it, put it on blockchain, and then differentiate yourselves. That's what I think you really need to think about as to what you want out of technology for your business.
John, that was a great point. There was an article I read a couple of years ago that I always note. It was actually written by a VC named Gil Dibner. It's called Systems of Intelligence.
Yeah.
And he actually makes an argument that he says, look, a lot of what we're doing, especially in this industry of collections, it's all commoditized. So much of what we do is commoditized. We all try and differentiate ourselves, but at the end of the day, we're calling someone up and trying to collect. But the reality is you have systems of intelligence, and exactly as you said, it's the domain expertise. It's basically adding that additional layer on top of what technically is commoditized, even from a technology perspective. And I couldn't agree more that that domain intelligence that each individual player brings to the equation is what leads to that success with technology, right?
I agree.
So, good point.
So I think if our audience is the non-technologist trying to figure out where to spend their money, I'm hearing 3 points. One is you have the legacy stuff, the piles of paper. And we all hoped when we came out of the 2008-2012 NPL crisis, we would never see a truckload of paper with a ham sandwich stuck in the middle of it, showing up to be scanned and then trying to figure out what to do with it. I guess we didn't manage to overcome that problem. And there will be truckloads of paper being driven and scanned and the like. So the message is you've got to deal with that problem. You've got to consult. The desk file in a commercial real estate NPL is one of the most valuable things that the buy side wants to see, which is the notes of the case officer, and with or without the ham sandwich. And how do you know, that's completely different than the, consumer credit file, which is all digitized. So you've got to figure out with how are you going to deliver that data to an outside buyer, because you will end up selling it. And then looking forward, you want to eliminate the paper entirely. So there's 2 different streams of activities. And then I think the third point that you made, which is, and don't build it yourself. All of these things are being done better someplace else, and it's just a question of figuring out where it's being done better. Does that resonate with what?
Yeah, I think so. And when you say where should you put your money, I suppose when I would look, if you've got a portfolio, let's just take it 10,000 assets. What is it worth to improve the value of that when you sell it by 0.5%? That could be your outcome by presenting better data. You're going to get more bids. You're going to get better bids on the back of it. You can take that cost down from what, 15 euros a document to about 50 cents. If just indicative, if you use technology in the right way. Different players will do it slightly differently, but the return on that investment is phenomenal at the point of sale.
And you're focusing on processes. So you're not even looking at the end game. You're looking at what does it take to get there. It's efficiency, it's effectiveness of your current day-to-day, right? So if you're thinking about, if you're a C-level person, thinking about what can I do now? How do I keep my job in 2 or 3 years? You should be thinking about those processes and becoming more effective. Worry about the outcome down the road. Get the quasi groundwork laid now. So yeah.
Yeah, and there's an element which probably we are assuming, which is not obvious. And you were mentioning that when he said eventually this is going to be sold, right? And losing the job there. So one of the problems with NPL is actually that people were making money out of non-personal bonuses by acquisition targets. So they got money because they were able to buy the portfolios. Then they handed over to the collection agent or the internal collection, and they were making money on performance. They're probably struggling. So, and nobody was thinking about what is who's getting paid at the IRR once the investment is closed, which is 10 years from now or when you sell it. Because this is it's very complex, a liquid asset class, and very few people are thinking about reselling portfolios, right? Eventually they did it, because that was a reality. So what happened, for what concerns us, is actually that all these processes were short-term, were tailored to short-term goals. And if you have to do what you were mentioning, right, and what you were mentioning, of creating a continuous upload and maintenance of data with accuracy, I said this wasn't in anybody's budget, right? So, and so you need, but as you said, now reality is that actually portfolio are sold on the secondary, tertiary market, and guess what? The guy is dead, as I said before, but the property is still on, and nobody knows where the property is. His property is still there. So, no, and you need to sell this, and you don't know where the property is still there. You need to send somebody, a drone or a person. So this long-term vision is still lacking many buyers, which are focused on short-term. But if you're thinking about, for instance, hedge funds, we typically have a 5 to 7 years average life of loans, and they buy a portfolio in year 2, and in 5 years they have to get out. And in Italy, the judicial process for bankruptcy is 10 years. Oh, so,
Or sometimes never.
or never, yeah, no, yeah, exactly.
You know, at the end of the day, I think it all comes down to the bidding, meaning that it's a win-win. The seller must have, you know, his data pool as rich as possible in order to have a higher price, etc. The buyer would like also to have a better portfolio in terms of data quality, etc. So you need to be, I mean, everybody should be happy with focusing on the data. Now, in Greece, at least, there is, in Italy, of course, it's a much more mature market. Currently, there is, you know, the secondary market picking up a bit. So we are seeing a lot of traction going on there. And again, about the bidding and pricing, it depends on how the previous servicer had, you know, managed the portfolio. Has it been enriched with the information? Has it been worked well? So you see there some pricing fluctuations a lot, even for the secondary market, which takes place now in Greece. In Italy, I know there is much more, I mean, granularity in this case. You know, at the end of the day, the richer in data there is a portfolio, I mean, the higher the price. It makes sense. Especially if it's secured as well. Because in unsecured portfolios, you see there are fluctuations. But in secured portfolios, having real estate, etc., you need to have data. You need to have rich information there.
And here, I mean, we talk about late in the process about the data quality of so forth. As you mentioned, the better the data you have, the more potential investors you will attract, and you will drive prices up. But I mean, you have to start early as well, meaning to build data quality, to build the standardization, the transparency picture, etc. It starts already, I mean, when your internal pre-collection work. It starts when you're setting up your outsource debt collection work, if you have that. How do you maximize the market potential? The panel before, we had several of the companies. You had you have the more traditional players, you have the fintech, the digitized approach, etc. The issuers must have technology to utilizing the total market, meaning that you have a benchmark setup when you can working with several DCAs parallel, building data quality, and then of course utilizing the DCAs that are best on the different type of asset classes, claim types, etc. And then when you have the maximized collection performance over time, I mean, obviously, one DCA could be better the first 6, 12 months, etc., but who are performing the best over time? Mm-hmm. And when you have set that in place, from that perspective, set the strategy, how should I sell my portfolio, when should I sell my portfolio, as a whole, partially, etc. And when you have done that pre-work, transparency, end-to-end perspective, you will attract and maximize the price when selling the portfolio. The investor will feel secure to minimize their risk buffer, and of course, when the investor had invested in the portfolio, in the same strategy can work with benchmark strategy on the collection and comparing internal towards to externals, etc. So that's what when we are talking about end-to-end perspective, it starts, I would say, from the underwriting, the pre-collection, and so forth, and to maximize the performance when it comes to selling or investing the portfolio.
Gifford, you asked the question as to where should you place your bets and invest in technology. I think one of the questions you have to ask before you can even answer that is, what's my objective? What am I actually trying to do? Am I going to hold this for a fair amount of time? So servicing is a real issue, because you've got to stop investing in technology at some point in time. So if you think about what your objective is, you have to decide how much data or how much technology do I need to support that objective. Because if I was to look at if you're holding it and you're a financier for a long time, you're going to have to do regular valuation. Do you have to send out valuers physically to go look at a fairly high cost? Or can you do sampling and automated valuation? And how much data do you need to support that? Because that will take out very significant operational costs and potentially even reduce your cost of capital, if that is a consideration. So I think asking yourself, what's my objective in the next 2 to 3 years is absolutely critical. Otherwise, you might overinvest, and we can all get very carried away about saying, you've got to have this, you've got to have that. And we're vendors, we love selling it. But ask yourself that question.
Yeah, but let me interject one more time, and I think this is a good conversation. What Johnny just said, I think is there might be an inevitable quasi-evolution in the market. The power is going to move up the value chain. So exactly what Johnny said, that you have to start at pre-collections, you have to start in the enterprise, you have to start capturing data at the beginning. And let's be honest, we all know that as soon as that data is captured, and it might not be now, because again, there's so much legacy there, but once that data starts getting captured earlier, the earlier the quasi-seller has it, or the earlier in the value chain that data is actually leveraged, then it shifts the power basis, right? And we know that's coming. I mean, it's back to the question of what do you invest in? Well, you better be prepared what's going to happen whether you like it or not. It's just a matter of are you going to be there early or late. So I mean, exactly what you said. It's the value chain, and if you don't start early enough, you might actually be chasing, where you can actually be now, you can be prepared for it early enough.
Actually, that's very interesting, because one of the things that we've started seeing is very large-scale global investors actually pushing their local units to invest in technology, or saying we as a group level want better understanding, because they're the people deploying the capital up front.
If I may add to what...
We'll let you ask more questions eventually.
Yeah, but
Listen, this is the easiest moderation I've ever done.
that's good. That's good.
How did you find so many opinionated people?
You know, I totally agree with everyone. I mean, a bit not with the investment in technology. You have to keep investing. I mean, to tell you the
We're all
truth.
aligned on that one.
You're going to be stoned by the audience if you don't say it.
Yeah, exactly. So, but okay. But you know, at least from our experience, what we are focusing to do is actually to provide to our customers, you know, a full-end experience, meaning from pre-collections up to the REO through one platform. And we are seeing that it goes towards that way because, you know, it's also about cost, having many vendors, especially for small organizations, okay, smaller banks, small funds, small servicers. I'm not talking about big banks where, you know, there are big operations, so they can handle that. But in small organizations, we see that this is the mandate currently. I would like to have one system that can help out from, as we said, pre-collection, early warnings, indicators, etc., up to the point that I have all the information I need for an asset and I can put it out in the market. So it's all, you know, it comes down to that, I think.
But that's very interesting. Our experience, you mentioned getting all the information, so as soon as you see the price, I can get it on the market, right? Our experience as a platform, I know we basically have banks and hedge funds selling portfolio to other banks and hedge funds, right? And big, large, small real estate base and unsecured, there's a big difference, yeah? But actually, the big difference between the user is somebody has a trading mentality. Somebody has not a trading mentality. Somebody comes to the platform because they got a portfolio, they need to get rid of it. Here's the data tape, sell it. Some people which got a trading mentality go to you and say, oh, here's the data tape. I don't know whether I got the right price. What should I do to get to push you investors into a competition where actually I get a price and then I see if I sell? It's kind of more, it's a different mentality. Guess what? The first data tape is completely horrendous. It's old, it's lacking information, it's inaccurate, and guess what? You don't get a bid on that, or the bid is very close to zero. The other process, actually, because the guys that has the mentality, their data tape is much better construed, and it's more accurate, it's more tailored for investors. They were buyers, now they're sellers. They're using the same mentality. The first guy was a bank, and probably, and he was a lender, but he was not planning to sell. So again. So this trading mentality, which is still very early day for some guys, but not for all, no? It's actually what is driving a lot the investment in technology, because the first guy has invested a lot, the second one is less. So it's really striking how the objective, you were mentioning objectives, what your objectives are. Are you up there and waiting for the moment, for the right moment to get rid of this portfolio, get the best price or not? If this is real, okay, then I'm investing. Then I want to know what is the mark to market every day of my portfolio. And maybe visit the properties as a sample from time to time.
But that's a good point. This morning, there was a comment made in connection with the banks and with the challenger banks. And so if you think about the mentality, I think it was with Solaris Bank, they brought up the point of, do you see these challenger banks or banking as a service quasi succeeding? Like, they've already succeeded. It's not will they already are. And that shifts the mentality of how you have to think about it, because they're technology first. So again, the mentality might also be shifted just by the inevitable evolution of the markets. It's not short term. This is not going to happen overnight, and it's still going to take some time, and we have a lot of legacy to deal with. But I think the mentality in and of itself might also just be just shifted by the nature of the shift going on in the industry. So, but again, you're absolutely right for today, and it's not going to happen overnight. There's no way.
I've spent 20 years talking to sell-side firms, and over that, I realized that my biggest competitor was hope. Because basically, when you talk to a bank, they've got a huge audience that's telling them, if we hold on longer, we'll recover this. Right? Next year, we have a plan. We're that close to the big recovery. And on and on and on. There's assets I've been tracking within institutions for 5, 10 years that still, we're that close. So similarly, the investment in technology right now, because I'm sort of the naysayer with it, a lot of people think we're not going to have another NPL crisis. I think we're going to have a huge NPL crisis in about a year's time. And it's going to be different than the two previous crises, but it's going to be huge. It's going to be SMEs, it's going to be office, it's going to be hospitality. But I'm not seeing the investment in the technology or the underlying data that tells me people are going to be prepared for that. And that wasn't one of our questions we previously discussed, so now you guys are off script.
But going to that point, you say, no, hope. Wasn't it one of your former presidents was confronted by hope is not a strategy, Mr. President?
Exactly.
Investment usually follows disaster, doesn't it?
Say that again?
Investment comes after disaster. It comes of necessity, typically. So if I walk down a street, sadly, in one of the off-hot market areas in London, I see 30, 40% shuttered stores or charity shops just paying the overhead. That is coming to be a major disaster, but no one is really thinking about what data have I got to support remarketing that, or looking at an investment strategy that turns it into apartments or whatever it's going to be. It's not happening. It will happen a year after people have got into the crisis and say, I've got a problem to solve. So it is that hope. I hope it's not going to happen, but it's pretty inevitable.
Alex?
Yeah, what you said about the crisis, I totally agree. Because currently, in many countries we are operating, we see the payment holidays, moratorium, still a bit active, not so much as in the first year, let's say, of the pandemic, but still active. I presume that all of this, when moratorium is ended and payment holidays are off, all of this will be the next wave of NPL, actually, across the board, in all segments of business segments. As you said, hotels, fast-moving organizations, etc. So we expect to see this down the line.
Well, look at the 1-2 punches. I mean, we're just getting out of Corona. I feel horrible about what's going on in the Ukraine right now.
Correct.
Who expected that 3 months ago? We all hoped 2 days ago that they didn't decide to march in.
Yes.
And how do you want to predict what's going to happen next year in the NPL markets? And I couldn't agree that I think people are underplaying it and they're hoping for the best. We've been proven wrong quite a bit over the last couple of years, so it might be time to think about how do we prepare for it.
It's sort of a grim note that, in fact, 2 years ago, almost to this day, I was sitting on a DDC panel in Kiev. So it's hard to believe where we are now. And so predicting the future is difficult, or if impossible.
Do you not see sort of political avoidance in even thinking about another NPL type crisis, in that many of the European governments have essentially guaranteed and keeping it currently as a contingency as opposed to actually a liability on their balance sheets? They really don't want to start envisaging that with really stressed finances as they exist even today.
And the reality is when you walk down the side streets, I mean, you brought it up.
Exactly.
You see kind of the day-to-day, everything's hunky-dory. But then you take a step off the main path and you see what's going on. It's the same thing when you fly to the U.S. It's the same thing on any main street. Take a detour off there and you see kind of what's coming at us. So, and not to be glum about it. I think there's also ways out of it, right? So if you think about what could be done, there are ways to mitigate quasi the downside. But if you just keep hoping for the best, not the best strategy.
So you just raised an interesting question, which is, in the U.S., the Small Business Administration has issued $330 billion worth of loans directly, not through a bank, directly. In Britain, it's 80 billion pounds through banks with service level agreements as to servicing them after the fact. Shouldn't these agencies, and I don't know, I'm sure there's a similar story in every country in Europe, shouldn't these agencies be looking at these technologies?
Well, in Italy,
Good luck selling to them.
in Italy, the number is 220 billion through banks, and there's been not really anything. It's press news that actually government agencies looking how to support the wave of NPL coming from that. The interesting thing, and coming to technology, is actually once the guarantee, because these are government guarantee stuff, right? Once the loan is granted to the SME, you got a guarantee from the government, then the company goes bust, the guarantee is activated. At the point in time, the guarantor, the government, needs to get the money back from the company. Guess what? Who's doing this in Italy? The inland revenues. No, okay.
Oh, sorry.
So can you imagine anything less technologically customer-oriented than inland revenues? No. Okay. So that's why the government knows that and is trying to address this problem by putting a more technologically sophisticated, dedicated servicer on that. So the problem is there. And guess what? Again, the driver was actually the technology, the ability of doing this. So is this going to happen in other countries? I don't know, because everybody's doing differently. But actually, it is an issue, and it's an issue of, it's also operational issues, and it comes with technology.
I think you said an interesting thing about the attitude of people, investors particularly. Are they trading or are they holding an amateur in a way? There was an example a few years ago, actually not that long ago, of Stockton, the city in California that went bust, the first municipality, I think, to actually go bust. There was I won't name them, hedge fund that was basically using sentiment data to decide whether to be an investor in or out of munis. And they were looking at the Twitter feeds, essentially, and we were scraping that and providing them with a sentiment analysis that basically said Stockton was voted the most miserable city in the US. Its fire department had fired 30% of its staff, and its minor league team had disbanded in the 1 year before it went bankrupt. They basically shorted that set of bonds and came out of it extremely well. I think we're going to see intelligent investors use that additional data that they can, even if it is non-traditional, to be able to get advantage. And that will be happening by the investors and arbiters who want to play the upcoming crisis.
But I think there's a couple of, just to unpack what you just said, there's a couple of interesting points. It's the secondary trader, the quote-unquote trading mentality, is dispassionate about the history, right? They don't own this loan with the idea, I made a commitment to this borrower and I'm going to see them, they're thick and thin, foreclose on a customer. That just doesn't seem to be. Whereas, the PE funds, for all their faults, they come in and they say, we bought it at 40 cents and we spent 5 years on it and we harvested all the low-hanging fruit and now we're going to sell what's left for whatever someone will pay. And in those sales, typically, whether it's a good tape or a bad tape, they say, get what you can. And I think the challenge is going to be for people to realize how far down these loans have come, and that goes back to this sort of data quality. So I guess we go back to this, how do you get people to invest more in creating, entering into a portfolio with the idea that you're going to be selling it, and originating a portfolio with the idea that you're going to be selling it. I guess that wasn't much of a question, it was more of a statement. But on the subject of questions, are there any questions from the audience? Please. Oh, sorry. Well, for our great audience in cyberspace, they will.
I can speak loudly. I've heard it's a very interesting panel, first of all, thank you.
Thank you.
Everyone has basically said short-term, long-term, when talking about investments, about changes. Can you quantify short and long-term? Do you have an idea on, when it comes to short? Because we have been talking about this probably from 2014. So what is this short-term? Because in my world, short-term is 6 months and long-term is 5 years. So in finance, so any idea? And this is to any of you, really.
Well, let's be honest, if you go to any large enterprise, I mean, it's if you're thinking about the sales cycles and just the implementation cycles, if you go to a large bank, you're looking at 2 to 3 years at a bare minimum to kind of go from point of contact to closing them to getting them implemented. That's short-term in their world, right? Because nothing changes faster. It depends on who you're actually talking to.
Well, I'm talking, we know what it's all about. We know that there is the first part,
Sure.
that the 13 billion JP Morgan is investing. By the way, everyone is going to benefit of it because the
Spread the wealth.
digitalization will go down in the secondary and the third part of the execution. So
There you go.
when the system is going to be, you think, able to communicate from origination to actual recovery?
Never. I'll just tell you.
Actually,
I know that.
you said
That's
about
why-
short and long term. I consider it neither.
I
don't know.
I agree with you, but
Yeah,
I
but-
just wanted to
Yes.
find, because it seems to me that it's a sort of permanent work in progress, and there is no end to this.
That's
Okay,
exactly
fine.
right.
So you
That's right.
responded.
No, I'll throw it at.
Long term is essentially never, because the bonus structures and everyone are set up in most financial institutions never to think about the long term. The short term is effectively a rolling medium term. You don't actually see anything, as you said, for 2 years in real practice. But you can, if you don't make some short-term decisions, you're never actually going to see any midterm. So it's rolling.
There's also a generational shift. Don't forget that part.
Correct. Yeah.
And
but I
but
think-
you have, for all of the NPL data tapes, and I've been involved with that process for my sins, it's very ambitious in terms of the number of fields, and it's incredibly costly to fill out all those fields for a 50 euro, cable bill. But it's the need for standards is always where you start. And, and it's difficult, given the number of disparate entities, especially within Europe, to get a single standard that people can work with.
And that's an interesting point, probably we didn't touch so far, which is the standards, and comes to my mind regulation. There's been multiple attempts from regulator to come to some standards, say to the data tape, to the reporting for securitization, referring to the ESMA reporting, to the regulation of servicer and banks in each country, or even there is a group now for the standardization of market practices in the secondary market. Now, how do we deal with selling a portfolio? So the regulator is trying to be on top. It's trying to impose a standard. Obviously, we know we all come from the market. There is no way to impose standard to the market. You can give direction. For example, when we set up NPL markets, we said, okay, we need a standard data tape. We take the EBA. EBA data tape was 400 fields. We started working 2.5 years ago. Now it's 950 fields. And it works only with 7. So you got 7 fields, you can get a prize. Of course, it's what it is. But actually, so even the standard cannot cover it. But there is a strong attempt from regulators locally and centrally to impose some standards which very often are linked to technology data.
quality. And they also have in mind this idea of secondary and the idea that actually you need to create data continuously. The ESMA reporting, which is a kind of template that applies to securitizations, is a loan-by-loan report, which is the first time that usually securitization have a portfolio report. Instead, the regulator, after years, said you need to have loan-by-loan report every quarter. So in theory, now, a loan, an NPL or performing, which goes into securitization, 7 years down the line, you have a track record, you know what happens. For only those 12 tables that actually, but you do have. So, and this has been a cost for servicer. This has been a cost. But, so if you're asking the question, where do you need to spend your bucks? Unfortunately, also in compliance. Unfortunately, also regulation stuff that you cannot foresee now, but it's going to happen. This is the trend.
But you're going through a shift right now. So you have a whole industry, back to this question, it's a good question. You have a whole industry right now going through a shift, and it's probably 20 years behind some other industries. We're way behind in this world when it comes to technology. I think it was Bill Gates who said something. We underestimate the short term and we overestimate the long term, right? So if you, back to that question, we might be extremely optimistic what's going to happen short term, but we're probably extremely pessimistic what could happen mid or long term, whatever the definition is. And I think the whole industry has to go through so many changes. So there's been absolutely quasi-varying commentaries about what needs to get done. But as a whole, the industry is shifting to a data and technology-driven industry, whether it likes it or not. It will ultimately become data and tech-driven. And that's a shift that, again, we might be underestimating what we can get done short term, but we're probably definitely very pessimistic about how quickly it then accelerates at the tail end. Again, I'm using a cliche term that I think Bill Gates said 30 years ago, but it's happened in every industry the exact same way. And everyone's first pessimistic, everyone is kind of skeptical about what they could do. You know, everyone doesn't want to change. No one wants to change what they do. You have to, it takes pain. And a lot of these companies have to go through pain first, and they will whether they like it or not. And again, so timelines, you know, we can be optimistic or pessimistic, but I still think it's going to come.
And I agree here. I mean, the short-term perspective can also hinder for enabling the tech that already is here.
It's already there, yeah.
I mean, it's next portfolio sales, next investments, etc. And another part, I mean, you were talking about referring to change. People normally don't want to change. You can ask a crowd who likes change. Everybody will raise their hand. And then you ask again, who wants to change? No one will raise their hand. So, I mean, the tech is there, but the short-term perspective can hinder to enabling the tech that is available. And I mean, it's not tech, it's not the answer and the solution to all the problems. I mean, tech should be enabling you to work in a more efficient way as an ongoing basis challenging your way of working. So I mean, you have to also have both the short-term but also the long-term perspective to utilizing the tech that is already here as well.
Yeah, and in a shout out to the European Data Warehouse, for those of you who are familiar with it, because they're an incredibly good example of the power of centralized data and transparency, because on the securitizations that are listed with them, that data has to be reported regularly in a consistent format, and they're doing some great analysis of it. And I think that's, you know, tech and transparency are sort of, you know, always joined at the hip. And for the problem for the primary seller, the bank that's got the loan on their balance sheet, is it's very hard for them, once they sell one loan, they worry about the accountants coming in and saying, okay, every loan like that has to be valued at the same price. And it probably should be.
Yeah.
And so that's this transparency changes the fundamentals of banking. Do we have any other questions? That was a great question. Thank you very much. All right, gang. What topics haven't we hit? We just touched on transparency.
Can we get past the first question?
Pardon? No, I know, exactly. I'm sitting there, we sort of went through them all. I think the transparency one, I think that's the one that we should focus on for a second in terms of, again, taking us back to our hypothetical CEO of a bank. Either how do I fight transparency? What's my cleverest use of technology to make sure that no one can actually see what's on my balance sheet? Or how do I invest so I at least have some transparency?
That's interesting. I mean, you had a discussion in the previous panel as well, and one party said we're welcoming transparency, we want to work with several DCAs, etc. And some other might be fair to, okay, transparency might show some weaknesses on the internal perspective. It could be a seller who shows some weaknesses from the data quality, or it could be a DCA who shows a weakness in that way of working. But I mean, here you have to have the view and welcoming the transparency and see it as a possibility to improve the things that you have to improve internally. So I think many people are talking about the transparency and are welcoming the transparency, but at the same, if I refer to if you like change or not, do you like transparency when it comes to you?
Well, the question is, are they going to step up and give you their data so that they can be benchmarked on an independent platform?
Yeah,
it's going to be that's going to be a hurdle. But again, once the first 2 or 3 are going to be tough. But once you get quasi, I hate to call it the herd effect, but once a couple of people do it and realize that there's benefits to be gained, they ultimately will be almost forced to follow.
I don't know. I think that my experience is a little bit appalling there, because actually everybody agrees on the concept of transparency, and even when they got the deal done on transparency, they got a better price. Still, the next deal, they go into the art of deception. So because actually, because it's human, no? You're selling something. You don't want to just open your kimono and it's human, right? Despite somebody told you that last time that you did it, you made a better deal, but this time you just feel restricted. It's about culture and it's very difficult to overcome. Maybe the younger generation have a different approach, but I mean, this is my strange experience, because I was surprised, right? Every time it's like this.
And that's what I'm talking about, the willingness to say, in a short perspective, do something that you don't like to gain in the long perspective.
So transparency is basically, bringing it back to COVID, a really accurate bathroom scale. So, you wake up in the morning, you get on and go, wow, I really have put on weight during this process.
At the end of the day, transparency is equal to regulation as well. I mean, regulation, you have to be transparent in order to be regulated, and especially in our markets, which are banks, especially, which are heavily regulated. At some point, they have to be transparent with what they're doing. Not so much the servicers and DCAs, etc. But it depends on the segment, I believe.
Please, you still have the microphone.
No, because, I was reading another report, and going back to what my friend Fulvio said, it seems that in Italy, which is the most relevant market at the moment, according to a study, there is a €1 billion per year saved by implementing right technology. That has been done with a 1.5% reduction of total cost of course, in the recovery and everything. It doesn't say whether this applies to banks selling or servicing. Doesn't go, but it says that the system. So a selling point is, to me, what do you think is going to be the IRR of any kind of investment in technology, whether it's from the servicing side or the banking side? Because at the end of the day, transparency is very interesting. Everything is interesting, but I want to know how much I'm going to get if I put this money on the table.
Who wants to jump
on that? He's going to throw out a number.
Ooh. I can't tell you about NPL specifically, but just from a fairly long history in both banking and insurance technology, that I can give you timeframes as well as some approximate amounts, that if anything's not going to give you a tangible payback in 18 months, you shouldn't have started it, as a first point. And when I would look at typically a core banking replacement, that you would perhaps be investing 70 to 80 million or so in doing a modest replacement, and you're looking for a payback over 5 years of about 3 times that in operational savings. That would be your business case going into it. Now, whether you can realize it or not is another issue, because the problem tends to be when you go into investing in technology, you forget to turn off the things that you said wouldn't be necessary to do. So actually, you're just increasing costs. So people talk about an end point and your objective for what your future state should be. You actually need what your future state should not be as well when you're actually looking at what your returns are likely to be.
It's actually what Paul said earlier, that first you have to change your existing processes, or at least to check, to change, and then go to technology. I mean, there is a standard case, I will get a new, fancy tool, etc., I will solve everything. It has to be combinedly. I mean, you have to go into the BPR, let's say, approach first, and then additionally check the tech behind that. The tool itself, cannot do magic. I mean,
JP Morgan put in 12 billion.
Yes.
You need to think that, the IRR is going to be very interesting.
in Greece, we have a very recent case actually with JP that bought actually a neobank for 1 billion. So it's the first Greek unicorn, as we say. So we see money, of course, again to go that way. But again, from what we have seen, of course, hope for us as well is something very good. But first of all, you need to check internally what I would like to check, objectives, as you said, and then check on other solutions. Because if you don't go the first way, it could be something to think over.
You need to look beyond the headlines on some of these numbers as well, because the reality is that they roll up all technology spend, and typically people, just to keep the lights on, are spending something of the order of 80 to 85% of their available budgets. Their actual innovation and change the bank budgets are relatively small. They're still very large when you're talking those numbers, but I'm saying that your actual choices become relatively small when you're operating at that scale. It's still great to hear that they are making very significant investments in changing.
Yeah, I think one of the issues is going to be also the Western versus Eastern situation, because we all know that the Western is lacking behind the Asian technology. So, and this is going to something that is going to be critical geopolitically.
You see a lot of skipping a generation. And you take banking in Africa, it skipped straight to mobile first from paper. It skipped whole generations.
Yeah, look at the
and I think
telcos.
you're going to see more of that.
And look at the telcos with landline and mobile. They skipped the whole 20 years of evolution in Eastern Europe. They never went to landline, right?
Okay.
Well, unfortunately, I think we could go on for another couple hours now that we're on to our second question. And the excellent questions from the audience. This is a tough one to summarize, but I think the message to the buy side and the sell side as the servicer is there are market-leading innovation happening outside of your own shop. You should be looking at it. In terms of your legacy book, you have a legacy book, and pretending it's not there is naive. But you should also be setting it up so that when you sell the loans you're originating now, it's part of a seamless chain. And you should recognize that you will be selling or securitizing or putting them into GACs or whatever. And the hold and hope strategy, given the amount of transparency the regulators are demanding, is unlikely to hold out. And with that, I would like to thank the panel because they've made this job incredibly easy, and the audience. And again, DDC, thank you very much.